Welcome to This Explainer. Today, we're unpacking veteran market analyst Michael Oliver's highly confident and honestly kinda terrifying thesis that the precious metals market is on the verge of a historic, violent shift. Now, if you track the metals, you already know gold has been grabbing all the headlines lately, but we're going to dig into the data suggesting a totally different dynamic is unfolding right beneath the surface. Stick around, because this might absolutely change how you look at commodities.
Let's kick things off with a pretty bold counter-narrative from Oliver. It really sets the stage for the whole argument. While the broader financial world is completely fixated on gold pushing to new highs, Oliver argues that gold is, well, merely having a yawn. He thinks that while gold is soaking up all the paparazzi attention, silver is the actual sleeping giant here, quietly gearing up to vastly outstrip gold on a percentage gain basis.
Section 1. The precious metals shift, gold versus silver.
The crucial thing here is how we categorize these assets moving forward. Oliver affectionately calls gold the mama metal. I mean, it's been in this steady decade-long bull rally since its lows back in 2015. It's the reliable one, right? The steady performer. Silver, on the flip side, is the undervalued catch-up metal. It hasn't had that nice, steady climb. Instead, it's basically been trapped in a historic multi-decade era. Think of it like a tightly coiled spring, just waiting for a massive release.
Now, to make these kinds of dramatic claims, Oliver isn't just staring at daily price charts. He relies on what's called momentum structural analysis. This framework tracks the underlying market energy and the really long-term momentum technicals, completely ignoring the daily noise. It's kind of like inspecting the foundation of a house instead of just looking at a fresh coat of paint. It identifies major tops or bottoms where momentum breaks out in a totally new direction, long before the actual price smacks you in the face. It's all about revealing the true architectural strength of a trend.
And speaking of daily noise, let's talk about the news cycle. In this type of analysis, geopolitical events, even major ones like recent tensions in the Middle East, are viewed as mere hiccups. Oliver notes that structural breakouts actually happen well before those crazy headlines even hit. The long-term momentum trends remain incredibly positive, and a massive breakout triggers when the intermediate trends finally align with that unstoppable long-term momentum. So, the big takeaway for us: don't let the daily news cycle shake you out of long-term structural trends.
Moving on to Section 2, the multi-decade breakout, breaking the ceiling.
History gives us some incredibly important perspective here. Just look at gold's past major bull markets. From 1976 to 1980, gold skyrocketed from $103 to $850. That is an explosive 8-fold increase. Then it happened again. From 2001 to 2011, it went from $256 to over $1,900. Another 8-fold surge. By comparison, the current bull market we're in, which started in 2015 at around $1,050, hasn't produced a move anywhere near that magnitude yet. So Oliver's arguing that today's advance is actually pretty modest when you line it up against those historic surges.
But here's where things get really wild. Think about this number, $50. While gold blew past its previous historical highs of $850 and $1,900 to find entirely new realities, silver was anomalously capped right near this $50 resistance level. Literally, for half a century, the market has kept a lid on silver. Oliver points out that markets make massive mistakes all the time. Think about the dot-com bubble or extreme undervalued ranges. He argues that keeping silver capped at $50 for decades was a monumental pricing error, and that lid is finally blowing off.
Section 3. History's explosive precedents, copper and lead. To see what happens when those multi-decade errors get corrected, the thesis points to copper and lead as stark historical evidence. Copper spent literally decades trapped between 50 cents and $1.50, but then in late 2005, it emerged above that ceiling and quadrupled in just several quarters, establishing a totally new reality around $4. The exact same thing played out with lead in 2010. It broke a multi-decade range and rapidly quadrupled in price. When commodities correct these long-term valuation errors, they do not just inch up, they reprice violently to catch up with reality.
And this brilliantly illustrates the anatomy of these historical moves, because they don't happen in a straight line. Step 1 is the breakout, piercing that long-term ceiling. Step 2 is consolidation. This is where the market spends several quarters digesting the shock of the new price level, which, by the way, is exactly where Oliver places silver right now. Then comes Step 3, vertical acceleration. This is the final phase where the absolute massive, life-changing percentage gains occur in just a few short months.
So if we apply the math of those past commodity breakouts to silver today, the projection is, well, it's staggering. Oliver suggests looking at a logarithmic scale.
Silver's historical range was roughly $4 to $50. That's a tenfold range. If you take that tenfold multiplier and apply it above the $50 breakout point, just to double the dimension of the range on a ratio scale chart, it mathematically points to $500. I know, $500 silver sounds completely absurd today. No way, right? But keep in mind, it is exactly the proportional mathematical move that copper and lead already experienced when they broke their own historic ceilings.
Section 4. The true macro drivers beyond interest rates.
But hey, math on a chart isn't enough on its own, is it? To answer what actually triggers this, we first have to clear up a massive misconception. There is a deeply ingrained financial belief out there that high interest rates are essentially kryptonite to precious metals. It's conventional wisdom passed down for years. Which leads us to ask this absolutely critical question. Do aggressively rising interest rates automatically crush the value of precious metals?
Well, the historical data says absolutely not. Oliver completely debunks this myth by pointing straight to the late 1970s. From 1975 to 1980, the Federal Reserve hiked rates aggressively, like a maniac, to use his exact words. And yet gold exploded completely vertical right alongside those rate hikes. The idea that high rates automatically equal lower metal prices simply breaks down when systemic issues take over. The big lesson here? Don't let conventional wisdom blind you to what the historical data actually proves.
So instead of staring at interest rates or oil prices, Oliver's thesis argues that the true catalysts are much deeper structural vulnerabilities. Look at the M2 money supply expansion. That is the actual true driver of inflation. Combine that with literally unprecedented government debt, deep rot in commercial real estate. I mean, just look at the total stagnation of the RWR real estate ETF over the past decade, and the growing instability in regional banks. It is a powder keg. Oliver notes that if just one major bank has a bad headline, panic sets in, forcing central banks to pivot and pump liquidity.
Section 5. The Silver Value Gap, a Historic Anomaly.
The data here is the ultimate tell. It illustrates the silver-to-gold ratio. Basically, what percentage of an ounce of gold an ounce of silver is worth. Back when silver hit $50 in 1980, its value was 6.5% of gold. When it hit $50 again in 2011, it was 3.1%. Today, it's hovering right around 2%. Oliver points out that simply to return to those historical norms, literally just to get back to the 3 or 6% range relative to gold, silver requires a massive explosive percentage gain from where it sits today. It has some serious catching up to do.
The structural momentum analysis suggests that when markets finally realize they've made a half-century pricing error, the correction isn't polite. It doesn't move in nice, easy little staircases. As this thought highlights, the repricing is sudden, it is an emotional burst, and it occurs so dramatically that it leaves latecomers scrambling. The takeaway is pretty clear. If you aren't positioned before that vertical acceleration phase kicks in, you're simply left behind in a new reality, forced to buy silver at wildly higher prices after suffering severe pullbacks.
Which leaves us with this final vital thought to consider. As macroeconomic pressures keep mounting across debt markets, real estate, and banking, and if central banks are forced to pivot and completely flood the system with liquidity, are we about to witness the dramatic, violent uncoiling of the silver market? Is silver finally, after half a century, just catching up to the reality it completely missed? Thank you for joining us for this explainer. Keep digging into those momentum charts, keep an eye on that structural energy, and we'll see you next time.